Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. Well, the yields once again took the limelight. The US 10-year yield hitting its highest level since 2007. The US 30-year yield comfortably trading above 5%. And what's more is that it isn't limited to the US. We are witnessing a sell-off even in Australian 10-year papers along with UK and EU papers as well. JK, decode this for us. Is it because higher and longer inflation period is being priced by the markets, or is it just a term premium adjustment that's happening?
Good morning, Swaraj. Yeah. I think the core issue here is not economic performance or inflation. Inflation was, of course, the trigger for rates initially going up. Now, the central point is the fiscal position of the US government. The fiscal deficit of the US government has gone up three times in the last 9 months. And the interest costs have gone up from 482 billion in April 2021 to 883 billion now. Now, the more you borrow, and the less buyers of yields, but yields are definitely going to go up further and will further add to the deficit through interest costs rising. So worse is that Fed is already doing quantitative tightening, in other words, selling securities from its portfolio. So the end to rising yields does not look in sight right now for me, unless there is a crisis leading to economic collapse and policy rate cut. So I will be interested to see what comment Powell will offer on the rising yields when he speaks today at the Economic Club of New York. But in the meanwhile, the rising yields, as you said, 5% on the 30-year and 10-year also inching towards 5%, has huge implications for mainly the dollar-indebted nations. And either they borrow less or pay more interest, and that way the investments into these EMs definitely get affected, and the global economic slowdown is definitely on the anvil. So I'm really surprised that the equity markets are still holding up despite all these developments. Of course, on the data side yesterday, we did not have much, excepting the UK inflation. That did not follow through on its declining trend of the last 2 months, and CPI rose 6.7%, the same as last month. Therefore, the conflicting signals, that is coming from the UK economy, with yesterday the previous day's wage inflation showing a slight decline and CPI holding up at the higher level, keeps the expectations quite balanced on BOE's next move. As I said yesterday, China did show an improved data on the retail sales, industrial production, and the GDP. That was encouraging, but China's structural issues continue to haunt the markets, particularly the debt of the real estate behemoths. Still looking for a bigger policy initiative from the Chinese authorities to address the economy. Until then, the world will keep feeling the impact of the second largest economy's slowdown. The notable data from US was the mortgage numbers. The volume of mortgage applications plummeted to the lowest in nearly 3 decades last week, as the interest rates on the most popular home loan, that is a 30-year mortgage, also hit the highest since 2000. A definite slowdown in the housing market, and I think it's only a matter of time the prices also start collapsing, which is somehow holding up so far. This can be a big trigger for market turbulence also, because we have already been hearing about the commercial real estate having slumped more than 40% in the key areas. The other focus on the market, the geopolitics, we are definitely in a very heightened geopolitically vitiated atmosphere across, and Middle East is one, of course, on the central focus. But one cannot ignore the recent events of damaged gas supply lines near Finland, where the sabotage is suspected. Ongoing rift between US and China also intensified, with US banning chip export to China and the latter protesting it. The meeting between China's Xi and Russia's Putin amid the current geopolitical tensions, and both criticizing Israel and also sending out message of big divide on the global stage. It's also coming at a time when Biden is also visiting Israel. So a new general, license issued by US Treasury Department authorized OPEC member Venezuela, which had been crushing in sanctions and since 2019, is some relief, of course, because the oil prices which are rallying on due to the geopolitical tensions may have some relief once they start exporting oil. On the markets, after a brief correction in the Asian time, yields soared to new highs, and 30-year is now perched above 5% mark, and 10-year at 4.93, and 2-year is well above 5.20 also. So selling has intensified after some intelligence reports from US confirmed that there was no Israeli involvement in the blow up of the hospital, which was a very pathetic incident to happen. Now US equities at last turned around to look at the negatives of the surging yields, oil prices, geopolitical tensions, and turning away from the earnings report. So Dow fell nearly 1%, while S&P and Nasdaq fell over 1%. Global indices and the European stocks were also more than 1% down. Today, it is a sea of red in Asia, with most markets seeing loss of over 1.5%. Now, adding to all this is the Iran calling for a full and immediate boycott of Israel by Muslim countries, that is contributing to higher oil prices, and the importing countries for oil are definitely feeling the pinch, and that includes India as well. One of the key members of ECB yesterday also said that he did not see stagflation in the eurozone, and he appears to be back onto the lips of monetary policy tightening if inflation persists. Now, GBP on the currency side, GBP reacted lower despite inflation falling, failing to maintain the downtrend, and that indicates an overall dollar strength. In fact, what I'm observing is a narrowing ranges for major currencies as well. That portends a sudden burst of volatility being not far away. On the rupee, nearly 3% rise in global crude prices and renewed outflows from FIs from Indian stocks has kept the pressure higher on the rupee, or rather on the USD INR. But the central bank's efforts to stem its decline to new lows has continued in right earnest. So we see more pressure building on the upside, even as US yields threaten to break and stay above 5% decisively. And the artificially held rupee exchange rate is likely to be let to find its level sooner or later. Looking ahead, we have some mid-tier data, but the focus is on Fed Chairman's speech at the Economic Club of New York, and we'll be keen to hear his reaction to the recent rising yields, which has a lot to do with the rising debt of the US government. So all in all, a lot to look forward to. Although markets are currently looking a bit calm, except on the treasury side. Even the gold has retreated from its high of 1964, but it all looks like a calmness for the time being, and more volatility to come. Thank you.
Thank you, JK. And just quickly summarizing, as you said, end of the rising yields does not seem to be in sight anytime soon. You know what the triggers would be: either an economic crisis or rate cuts for some fall in yields. And now, of course, markets will be focusing on what Powell has to say today on this rising yields issue. So we'll be keen to hear his thoughts. In the US, we are seeing a fall in the volume of mortgage applications. They have fallen significantly, and it is a telltale sign of the higher rates. And on the geopolitics, a lot of things are going on apart from the kinetic war which is going on. Just as JK mentioned, Finland's gas pipeline being sabotaged, or US uh, banning chip exports to China. So a lot of other kinds of geopolitical games are also being played. So that's something to keep an eye out for. And when it comes to currencies, major currencies are trading in rather narrow ranges, but not as narrow as the rupee, of course. So as JK mentioned, it can be just the calm before the storm. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets. Thanks for listening.